Welcome to Subramani. I'm going to talk about debt funds. If you look at all the mutual funds, their equity portfolios are surging, but their debt portfolios are not surging. Whatever it is, right from liquid. I don't want to talk much about liquid. Liquid is largely a corporate thing. But your short-term income funds, your medium-term income funds, or your longer-term income funds, or your gilt funds, this is not attracting enough money. I'm surprised that it is not, because one possibility is your advisor is not giving you right advice, or your advisor is telling you look at the past returns. That is one of the worst things to look at, because going forward, I think debt fund will give you good returns. Go and look at their YTM and see where they are. If they are at 7.25 and the 0.5% costs, then you're going to get 6.75 as the yield on that, and that's not too bad, right? Yes, we have the gilt touching 8%. Not touched 8, but it is very close to 8. It is 7.75, 7.5. So 7.35 is what the RBI bond is giving you. Believe me, it's not too bad if you are a 70 plus investor. If you don't need the risk of equity, 7.35 is not too bad, because even gilt is not yet touched 8. So this is gilt, right? So yes, there could be some liquidity issues for RBI bond, because you may not be able to get liquidity very quickly. But I do think the RBI bond looks attractive enough for me, which means it's a good time to be investing in maybe even in gilt funds. Now, I do invest in one gilt fund, which has order 2045 maturity, and I keep pumping money into it on an SIP basis also. Why do I do it on an SIP basis? Why can't I keep it in an ultra short bond fund and shift it there exactly when the market moves? Because I have no ability to know whether the market has moved. What happens if I wait for 8% and the market stays on at 7.95, tantalizing enough, and then starts coming down? So would I have got it right? Would I have got it wrong? I don't know. I don't like timing the market in equity, and I just can't time the market in debt for sure. So I do a SIP into this, but whenever I see some interest rate movement which is very good and attractive, I go and dump a bigger amount into it. Why am I doing that? Because I want the maturity in 2045. I hope my income will be at its minimum in 2045 if I am alive, that is. So that is what you have to look at. So is this a good market to invest in debt? Yes. Should you be looking at duration, or should you just be looking at investing in regular debt? If you are sure you want to take the duration risk, it's not too bad. But if the 10-year yield and the 30-year yield and the 1-year yield are all around 7.75, I don't see any need to put money in the longer term investments, unless you are sure that you want it after that period of time, and you are sure that you can take the fluctuation, and you don't want current income. Please remember, it is and. Like if you don't mind current income, let's say you're 70 years of age and you want good quality income, gilt is not too bad a bet. RBI bonds is not too bad a bet at 7.35. However, if you say, no, I'm 50 years of age and I want this money only after 20 years, then you should look for a longer maturity, 2040 maturity or 2045 maturity gilt. And such funds are available. Now, a lot of the mutual funds will launch 10-year maturity. So if you're 52 years of age, it's a very good bet for you, because you know you will need the money only after 10 years. You should have that clarity. It is not about shortage of products. There are 10-year bond, 10-year maturity plans, target maturity plans, which is 10 years, 7 years, 5 years. So you have to have the clarity as to what you want. So if you're 59 years of age or 58 years of age, a 5-year bond will work for you. But if you're 48 years of age, even a 10-year bond is not going to work for you, because you will get all the money in when you're 57 or 58, and you'll have to pay tax on that. For you, it is better to go into an open-ended gilt fund, where you will withdraw only after you retire and when you need money, right? So depending on that. But Is it time to start allocating money to debt for older people? Definitely. For younger people, if they have money, is it time to put into ultra short bond fund because they've got some goals? Yes, you could put in ultra short bond fund, you could put it in arbitrage fund, you could put even in short term income fund if your view is 2-3 years, right? But floating rate fund, right, all these funds are doing well. Gilt will also do well, there is no doubt about that, but if you wait in Gilt for it to touch that 8%, I don't know how long you will have to wait. I don't know whether it will touch. Maybe it will touch in next 2 months, 3 months. Many people are waiting. Many top fund managers whom I spoke to are saying yes, interest rates have to go up simply because the government is borrowing a lot and corporate India needs money and banks don't have enough money. One fund manager, I mean Naren, said the gap between what the industry needs and what the banking sector has after meeting all the requirements of what the mutual funds will give and insurance companies will give is about 5 lakh crores. This 5 lakh crore gap is bound to push interest rates up. So companies will come out with bonds and these bonds will be placed with mutual funds, provided mutual funds have money, right? If the investors and the advisors get money for the mutual funds to invest in debt, then debt instruments will take off or interest rates will go up and it will be met by foreign borrowings. So it's not a question of if Indians don't invest in debt, what will happen? Nothing will happen. Foreign investors will meet the demand. I also think that the Indian equity markets did very well in 2021, 22, some end part of 20 also is because the SIPs did very well. We could weather the storm of an FII selling. So FII selling was met by DII buying and we ended up calendar 2022 with about 4% return, plus 4%. If the SIPs figures were not so robust of 8,000 crores, 10,000 crores, 13,000 crores, I don't think we would have ended up 2022 calendar positive. But having said that, to ending 2023 calendar negative seems to be does not seem to be impossible. So be careful about that. But putting money in debt now makes a lot of sense, especially if you have ignored your asset allocation and you have not paid in, and you are getting older in the sense that you have lesser time to recover from a bad market. So if you're 75, 77, removing some money and putting it into a gilt fund, maybe I'm getting the timing wrong. Maybe you could do a 10,000 rupee SIP or SGP into a gilt fund, and once the interest rate peaks out or you think it has peaked out, putting in a bigger amount. I think you should do that. And also I think very good chance that equity funds will not do well in 2023. But having said that, lot of FII selling has happened in 2022, which was absorbed by the DII. Now, if the FIIs were to come back in 2023, you know the kind of shares that they will buy, right? So those shares will go up and 70-80% of their buying will happen in the index. So obviously market could end up positive, but I'm not so optimistic about equities. I'm far more optimistic about debt on a 2-year basis. Have I shifted my money? No, I am very clear that I am 90% in equity. It doesn't change much. It may go to 85. That's about it. Some little money, yes, will go into debt. My way of asset allocation is very simple. If I have enough money for the next 10 years, in debt funds, anything more than that is a waste, because my household expenses are met by my dividends. So my asset allocation is very different. But if you have ignored your asset allocation, sit with your advisor, understand and do asset allocation. Putting some money in the longer end of the curve is not so bad. Or you have something like ICICI has something called all season bond fund, which has got or anybody who's got a bond fund which invests in lower end and higher end. So the fund manager can walk where he wants to go. Does he want to put in a 10-year or a 30-year? Let him make the call if you are not confident of making the call. Thank you. Oh, I forgot to add this, but it is important to worry a lot about corporate quality of debt. So you will have a high quality debt portfolio which gives you lower return, and a lower quality which gives you a higher return. You have to make a choice where you want to be. So if I were you, I would largely be 70% maybe in short term funds, arbitrage fund, and liquid fund, ultra short bond fund, and 30% I'll play around with some credit risk fund or gilt fund at the higher end of the duration, which means something like a 7-8 year duration or even a 20-year duration. So make sure that you know what you're doing, because exactly like equity where you develop a core and a satellite, you can do a core and satellite, but into your core you should not be taking credit risk or duration risk. Both the risks are worth avoiding, because we are not experts. We do not know what will happen to interest rate. So 70% should still be in the core, which is what I mentioned, because even the floating rate fund and arbitrage fund are giving you good returns today. So that can be part of your core. But with 30% you can experiment the way I do. I largely experiment only, right? My debt fund exposure would be, I have credit risk fund, I have a longer maturity gilt fund which is maturing in 2045, right? So which is Nivesh Laksh, and I'm doing that kind of stuff, right? So why? Because my debt investment requirement is largely met by mine and my wife's public provident fund. I don't want to do more debt than that. Then there is always some of these funds where I experiment with, and like I said, my expenses for the next 10 years is in debt instruments, not including PPF. So having said that, I don't need to put more money in debt, but if I had to, I think it's not a bad time to start investing. I'm sure that interest rates will go up, but I do not know how long, I do not know how much. At this stage, I would partially put maybe 10-15% of the money that I have for debt, I'll put it into debt with a longer term maturity. Thank you.